An ESPP. What is it exactly? And if my employer is offering it, should I be taking advantage of it? The answer to both of those questions is absolutely. In this video, we're going to talk about what an ESPP entails and some things to look out for to make sure that you are not leaving any money on the table. The ESPP benefit alone has allowed me to increase my yearly salary at Microsoft by thousands of dollars. Let's jump right into it. ESPP stands for Employee Stock Purchase Program. It is a plan that is offered to corporate employees to purchase public company stock at a discounted price. When you opt into your company's ESPP, you provide a percentage of your pay that gets allocated via payroll deductions to be built up between a start, which is referred to as an offering date, and an end, referred to as a purchase date. The time horizon between the offering and purchase dates can vary. For example, at Microsoft, our ESPP window is 3 months wide. At the end of every 3-month period that I have opted into the ESPP, Microsoft's going to use the accumulated funds to purchase the company stock on my behalf. There are 3 key things to note with an ESPP. Number 1, ESPP participation is completely optional, with the only requirement being that the employee does not own more than 5% of the company's stock. Number 2, if you opted into your company's ESPP and you decided to opt out between the offering date and the purchase date, you're going to receive the money that you funded to it back in full without any stock purchases, because the stock is only purchased at a discounted price on the purchase date. Number 3, the discount on stock for an ESPP can be as low as 5% and as high as 15%. Also, you can only contribute up to $25,000 of your money each year per the IRS rules. While buying shares through an ESPP doesn't have many roadblocks, selling those shares will trigger a reportable tax event that you're going to want to pay attention to. ESPP tax rules are going to take the price of your shares on several key dates, including the offering period, the purchase period, and the time that you decide to sell your stock. Depending on the timing of all of those events will ultimately determine if your tax liability falls within a qualifying disposition or a non-qualifying disposition. The tax implications themselves would warrant another video because of all the details that are involved. But the main difference between a qualifying disposition and a non-qualifying disposition comes down to when you decide to sell your shares after the purchase date. A qualifying disposition is when you hold your shares for more than 1 year after the purchase date and 2 years after the offering date. In this situation, you end up paying the least amount of taxes. Whereas with a non-qualifying disposition, you end up selling before those times, which ultimately means you pay more taxes. On the surface, a non-qualifying disposition can seem unattractive, but it actually allows you the opportunity to avoid single stock risk so that you can diversify outside of your company stock. And also, you can immediately cash in on your stock, which could allow for other long-term savings goals or if you needed that money in the short term for personal consumption. To add on to this, you can come out even more ahead if your ESPP has a look-back provision. In this case, the purchase price is going to be determined by the lower price of the purchase date or the offering date. This is extremely powerful and in some cases can mean hundreds of extra dollars in your pocket. For example, let's say my take-home salary is $300,000. I've also looked at my ESPP benefit and I saw that my purchase date for my company is every 4 months. We have a look-back provision and the discount that we get on the stock is 10%. I've watched Jeremiah's video on ESPP that I've liked and subbed to, and so I know this is awesome. So I decided to opt in to my ESPP by contributing 10% of my pay to it. So this is gonna come down to about $30,000 a year. So every 4 months, I would be contributing $10,000 for stock purchase. At the beginning of the offering date, my company stock was at $50, and at the purchase date, our company has been doing incredible, and so our stock doubled. So now our stock price is at $100. Since the stock was lower at the offering date, then I'm gonna be purchasing my stock at $45 instead of the $90 if I didn't have a look-back provision. So I essentially ended up with 222 shares rather than 111 shares. Now, this isn't gonna matter as much if you decide to quick sell and quickly cash in on the 10% discount. However, this is extremely powerful if you are deciding to hold those shares for the long term. At Microsoft, we don't have a look-back provision. So my decision as to whether I'm gonna go long on my company stock or not is more a matter of diversification first and foremost. I don't think it's a good idea to have 10% of my net worth tied up in a single tech stock, no matter if I work for the company or not. So the 10% discount that I receive at the end of each ESPP period is enough for me. If you are at a company that has a look-back provision in their ESPP, then it is a great option to hold it for the long term, and even holding it long enough so that it's classified as a qualified disposition, so you are taxed at the lowest rate possible on the appreciation of your stock. Checking if your plan has this provision or not is totally worth the few minutes that it takes. It's gonna ultimately influence the decision you make on whether you're gonna sell your stock immediately or give it some time and wait a little bit longer. Many folks I work with like to approach the ESPP like a delayed passive income. You are essentially withholding part of your salary to lock in a guaranteed return every 3, 4, or 6 months. The first offering period that you decide to opt into your ESPP is gonna be the hardest because you're gonna be taking home less money every 2 weeks. But if you decide to sell at the end of each period, you're gonna be getting that income back every 3, 4, or 6 months with a little bonus. If you are offered ESPP at your company, take it. The compensation package that you are offered factors in the fact that you're gonna opt into the ESPP. So if you say no to it, you're leaving money on the table each year. If someday you work your way up to the maximum $25,000 a year that you can contribute to your company's ESPP, that is essentially like a $4,411 gift every year that your company's giving you by just delaying your income by 3, 4, or 6 months. Over a 30-year career, this employee benefit alone is worth a little over $132,000. Let your money work for you. And just remember that in the case of an ESPP, it isn't available to any investors who don't work for your company. You don't get opportunities like this too often, so make the best of it. If you found value in this video and you're interested in topics around maximizing corporate benefits, wealth creation, or personal finance topics, be sure to subscribe. And also check out the Investing 101 playlist so you are well diversified and aware of different strategies to help you build wealth efficiently. Thanks for watching.